Guys, John Polemy here, Actionable Intelligence. Today, Saturday, August 16th. It's the weekly market update. A disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a registered financial advisor. I cannot give you individual financial advice. Please do your own due diligence. It's your money. It's your responsibility. Okay, just want to remind folks that about my Substack, a lot of new people come on board. We have a free offering that goes out every week, pretty much every week. It's a cure where I curate all of the things that I'm looking at that I found interesting throughout the week that kind of apply to what we're talking about here, whether they be articles, podcasts, videos, what have you. A lot of people find that interesting. We also have a paid product that has two tracking portfolios, basically to take advantage of the themes that we're talking about in these videos. So if you're interested in that, feel free to go over there. Down in the show notes, they're linked. We also have a Actionable Intelligence Alert Facebook group for people that want to just congregate there. That's a good place to go. And a lot of the charts that we have in these weekly videos end up over there. There's also people posting that are in the group that are posting there. So it's starting to build a critical mass. Some people, if you're on Facebook, some people find that interesting also. All right, let's get into this week's slides. So Goldman Sachs came out with this chart showing the combined trailing PE, forward PE, Kate, price to book, enterprise value to EBITDA, Q ratio, market cap to GDP, all kind of put together into a average percentile. And they're bullish, but they put this out. Of course, everybody's bullish if they're on Wall Street because more activity creates more fees. More activity creates more action, more pinball action for fees and for uh, commissions and what have you. More new products to be introduced. So this is what they're all about, assets under management and activity. And so what we can see is if you take all of this, you go back to times when we have major market overvaluations that resulted in long periods of rest and reorganization, 1929, 1966, 1999, and then you see the current circle in red here. Of course, we don't know when the current bubblicious conditions will end. We've been talking about it for a couple of years. They continue. I've said that many times. Bubblicious bubbles can continue for many, many years longer than people think, but inevitably they all end the same way. You always return to the mean. You know, the thing that seems to be driving this particular bubble is the whole AI revolution, if you will, the AI that's happening in AI. Again, I've saw this exactly during the internet. The internet, everybody was crazy about it. A lot of companies had tremendously out of whack valuations, and eventually it corrected. And of course, the internet's been part of our life since then, and it has done a lot of positive things and has changed the world. But it doesn't mean that the valuations can just continue to go up and up and up forever. And so we're at one of those points right now. People can do what they're going to do. People, you know, I get comments in the show in the so occasionally that you're just mad because you missed out. I didn't miss out. I'm doing quite well. But I don't, I don't play in bubble areas. The whole theme of the Actionable Intelligence Alert newsletter is to sell overvalued things and buy undervalued things. I have found that that is a more long-term way to create wealth and keep it. What we see right now is just rank speculation. None of these companies, nobody buying these companies nowadays can justify the valuations. And so they don't. They just have a view that it's just going to continue because it went up yesterday, it went up today, and it'll go up tomorrow. And so I buy and then with the view to sell it for a higher price. Well, this is speculation, and speculation is fine. I speculate also, but they're not following what the whole purpose of investing is, which is to buy businesses at a reasonable valuation that have the ability to reinvest capital and compound wealth over time. Companies are just too expensive, regardless of whatever yarn is spun to justify the prices. So again, it's a free country. People can do what they want, but I mean, you're really out on thin ice historically. And so I think eventually something will happen to turn this and things will revert to the mean. We've seen it before, and a lot of folks are going to, again, suffer a lot of pain. So here I am picking on Palantir again. This is the valuation as an outlier among 500 S&P 500 stocks. This is the forward price to earn sales ratio. These are some of the other companies. Here's Nvidia, Tesla. There's a forward price to earnings ratio. So based on price to earnings and price to sales, this thing is such an outlier. And it's just crazy that people are buying this and thinking that this is, investing. But to each their own. I just think these things are, when you see them visually, it really paints the picture of how stark and how crazy some of this stuff is. And of course, it's always at the end, it's the retail investors. Retail investors are buying U.S. technology stocks at the fastest pace on record. The retail flows as a percentage of aggregate market cap, at least going back to 24. Here's your S&P stocks, but here's the NASDAQ 100. So it's always retail at the end that comes in, right? The people that know the least about the market, the least trained, the least educated on things, the least experienced, they come in at the end. And then typically some event will happen, some catalyst will come along that causes a rug pull, and then these things implode. So I found this interesting. Here's another sign of the bubble. You see things like this. This is just rank speculation. I think this person has 40 or 50,000 followers on Twitter. And they say, my daughter, now 12 years old, is up 47% year to date. Her small Robinhood account is crushing 99% of you. By the time she goes to college, she is going to have 100,000. All she does is buy Leap high 70 Delta calls in good companies after pullbacks. Yeah, because why not? Because the market just goes up after a pullback, right? That's what it's always done in my, if you have a 12-year-old, how old are you really? 30 years old? Where were you during the tech implosion? Well, you're probably 10 or 11 years old, right? Eight to 12 years old. You didn't know what was going on. This is kind of similar to the story I tell about what I saw on CNBC during the tech bubble. They had these different people on. This one obnoxious person, Surge the Trader. That's what they put this guy. He was sitting at a bar in New York and he had a martini in front of him. And they actually put this on CNBC and they had it under, you know, the, the block under that with thing, Surge the Trader in parentheses. And they were actually, I mean, this guy looked like he had been waiting tables at Applebee's, 6 months prior. And so he was riding the train. Everything was going up just like now. Everything was roses and Skittles and unicorns and ice cream cones. It was just, we're going, people, you don't understand, John, what's really happening, how this is going to change the world. Heard this all before. And so they had Surge the Trader, martini glass and a big cigar, lit cigar. I guess you could still smoke that inside bars in New York. And they were actually asking this moron questions, and he was just the most obnoxious, arrogant person I've ever seen. And he was getting a little bit frustrated, because people were like, well, what about valuations? He didn't have any answers because he was just riding the wave. Okay. The hurricane came along and even turkeys were flying. And so he was buying this. He was doing all these strategies with leverage and calls and options and all kinds of stuff. I don't even remember all the stuff he was doing. All whacked out stuff that works as long as the market keeps going up. And so he finally got a little bit frustrated. And I guess I remember the statement that he made. He took a big pull on the cigar and blew the smoke into the camera. And he made this statement I'll never forget. I've told this story many times, but I just thought it was so funny because it was right near the top. He says, "This is the first time in the history of the world people my age have had this kind of wealth, and you better get used to it," unquote. And I just thought to myself, this guy's the biggest dork. This guy's the poster boy for the bubble. And of course, I don't remember the exact timing, but eventually, we know what happened. Heck, wreck. And I often wonder what happened to Serge the trader because we never heard from him again. I don't know if he's back at Applebee's or working at a car wash or got a real job, as a mortgage broker. Who knows what he's doing? I don't know. But I just thought it was, and this is kind of reminded me of this because by the time his 12-year-old goes to college in 6 years, she's going to have 100,000. Yeah, as long as what keeps happening happens. Your strategy only works as long as buy the dip continues to work, which I'll be with you. It has continued to work so far until it doesn't. And then what's your strategy? Because are you a real investor or are you just, everybody's a genius in a bull market. Everybody is a super genius in a bubble. And so we will see. I just thought this was, people will ask in the future after this thing blows up, well, where were the signs of the bubble? Who could have said it was a bubble? Who, come on, John. No one knew it was a bubble. Well, this is the signs right here. This is the shoe shine boy. Jaguar Analytics. Who is this person? You know, and they have a tremendous following and it's working. So, as I say, I wish you well. I hope it continues to work for you. It will work until it doesn't work. And then I hope you are able to find another strategy and continue the wealth compounding. But we see this one hit wonder stuff in many bubbles. And I just think it's amusing when I see these things. These are signs. So another reason why the market is kind of staying elevated is the pace of corporate buyback. Um, why are companies buying? It makes sense to buy back your shares if they're undervalued and if you have the ability to compound capital. But just to buy back shares to do it, in some cases, is not the best use of capital. And I think buying shares back if your shares are overvalued is a poor choice, which happens a lot, quite frequently. And so you really have to understand when you see companies buying back shares, do they have another use for the capital? Can they be paying down debt? Are their shares overvalued? Has the management demonstrated itself to be a wise allocator of capital? Because a lot of management teams aren't. And what are their particular incentives? And are their incentives skewed such that they could just buy back shares regardless of the market conditions or the company, of the company's valuation, what have you, because it benefits them and their particular outcome, whether it be stock options or what have you. And so you really need to take that into consideration. I like stock buybacks, especially with companies that I buy, especially a lot of them in the dividend portfolio, because they're buying back their shares that I consider undervalued. And so that has worked quite well, especially with European banks. And I believe it'll eventually work with a lot of the energy companies that we've talked about in the past. So I saw this stat and that just blew me away. This is tremendous. Roughly 50% of Nvidia employees are now worth over $25 million. That is crazy. Roughly 80% of Nvidia employees are now millionaires. The AI revolution is producing unprecedented wealth. Yes, I agree. But is the wealth going to last or is it temporary? That will be the question. But this is a tremendous statistic. I had no idea. It's really something else. 50% of the employees at Nvidia are now worth 25 million, over 20 over $25 million. So it begs the question, how motivated do you stay if you know you're worth 25 million? Or do you look to, another problem, what will happen is eventually Nvidia will stumble. Eventually they'll make enough chips, the market will be saturated, the growth will stall, and then what happens? So if you have all of your wealth tied up in Nvidia stock, it may be structured where you can't, but I would be selling down my position as fast as I could if I was, it doesn't mean you have to get rid of all of it, but you got to book it. You got to book some of it so that you're, even if you could book half of that 25 million, you're set for life. Your kids are set for their lives. If you want, but how do you keep employees motivated when they're all millionaires, basically, and 50% of them are, have 8-figure wealth? That's crazy. So anyway, interesting stat. And so we talk about AI wealth creation. This is exactly right. The AI revolution is producing unprecedented wealth. Well, John, what is actionable intelligence doing? You're missing out on this. No, we're not. This is how we play it. This is how I'm interested in it, looking at it through energy. Um, I think the best bet for this decade, for the next 10 years, not just because of AI, but just the tremendous demand for electricity that's going to happen from all these new technologies, whether it's data centers, AI, robotic, electric vehicles, all of these things are going to require a tremendous amount of electricity. I mean, we're just at the cusp of this robotic revolution that I think is going to happen, where we're going to have humanoid robots and robots of all types, and these are going to create another vector for energy. See, this is why energy demand will always go up over time, and why these ideas of net zero and all these things, they're ridiculous. They don't match reality. And so, a way I believe this way, I don't have to pick who has the best chip, who has the best AI, whatever software or what have you. I don't have to pick that stuff because they all require energy. I am the toll master. I am the toll booth. If you want to be in any of these technologies, it requires a tremendous amount of energy. You must pay me. And so are my returns going to be as great as if I would have picked Nvidia? No, but that's difficult to do. What's the next Nvidia? What's the next company that's going to do what Nvidia did? What's the best technology? Picking that. No one can know, but I all know that they need electrons and they're going to need a lot more electrons. And I think this is the way to play this is through energy and the demand for energy. And so it says here, U.S. annual electricity demand, you can see that it climbed basically up to about 2004. And it's kind of been going sideways for 20 years. And now we're breaking higher right as the cusp of all of these technologies is starting to hit. Since U.S. electric loads were stagnant during the 2010s, but are growing again due to technology companies building data and computer capabilities. But again, it's not just going to be that. It's just going to be this further electrification of all of these things. And again, these other emerging technologies, which I believe are just going to be tremendous consumptions or tremendous consumers of electricity and power. So let's talk about the Permian. It continues to decrease. Permian well completions down 21% year over year. Here's your Permian active drill rigs going down. Here's basically last year. You're down about 21% in new wells completed. Of course, we've said this over and over. We're going to eventually see a decline in production. The EIA finally came out this week, I believe. I might have it in this deck. I don't remember. But the EIA is even saying that you can see they're reporting from 2024 to 2025, there's been a slowdown in production, still positive, but 2026, they're forecasting like 160 to 200,000 barrels decline in U.S. oil production. And so I think it would probably be worse than that. Prices stay down here. Simply not going to invest the requisite amount of money to grow production, forget about growing production to even maintain production because, again, of the decline rates. Yes, I understand about rig efficiency and things like that, but it looks like the declines are happening faster than the rig efficiency. And so net, you're going to end up with declines. And so again, I'm kind of conflicted. I haven't made my mind up if this is just uh, pricing causing this or it's a geological event. I suspect it's a combination of both. As the tier one best, lowest hanging fruit gets exhausted, you now have to move into more complex, harder to drill, harder to complete, higher cost areas. That's why they weren't originally drilled first because of that. The easy, cheapest stuff is drilled first. And then as that depletes, you move into the more difficult, higher cost situations. And so I think that's what's going to happen. We're also seeing a move more and more, especially starting with a lot of the European integrated oil companies, and now like companies like Exxon and Chevron moving more and more offshore, which are going to benefit us tremendously in the portfolio because kind of situated in those areas. So here's an explanation. Rig counts down, why not production? From Q1 2023 to Q1 2024, rig efficiency increased 14 to 16% in the Delaware and Midland. These are areas of the Permian, by the way, respectively, while the rig count itself only dropped 11%. This, coupled with a 6 to 9 month lag from spud to first production, ultimately led to an increase in production through 2024. From Q1 24 to Q1 25, the Permian saw rig efficiency increase 12%, while the rig count only dropped 4%, once again leading to increased production in 2024 and through first half of 2025. However, we've seen a step change, and now Q1 25 to now, rig efficiency has only increased 4 to 7%, while the rig count has dropped nearly 20%. Put another way, Q1 25 to Q2 25 were the first periods in recent history where the Permian saw rig count losses outpace efficiency gains. And this is why that even though you've seen rig count come down, you've seen production increase. And so now we're in a situation where efficiency can't just go up double digit forever. It's not possible. You start getting into compounding problems. And so efficiency has only increased 4 to 7%, and yet the rig count has dropped 20%. And so you have a net, um, you have situation where the rig count losses are outpacing efficiency gains, and eventually you will have production decreases. So I thought this was an interesting explanation off Twitter. Somebody put up. This explains a lot. A lot of people are saying, well, when's the rig count going to start affecting production? And I think we're in that zone now. So here's the chart I was talking about earlier. EIA is admitting production will decrease. You see 2023, you had the annual change. These is the annual change in production in millions of barrels a day. You see then 2023, oil production was up about 940,000 barrels a day. Then last year, it's dropped to, it was a gain of 270,000. This year, they're talking about a gain of 200,000, and then next year, a decline. So this is what's starting to happen. Uh, this is the short-term energy outlook, August 20. So even the EIA now is saying that next year so you have the plateauing happening and now a decline. So again, is this price? Is this geologic? Is it a combination of both? I believe it's a combination of both. Of course, if oil were to go to $100 a barrel and stay there for some period of time, I think a whole bunch of rigs would come back and a whole bunch of marginal uh, wells would be drilled. But we've seen over and over from the data, from the conference calls of these companies that at current oil prices, it just doesn't make sense to drill. And so they're dialing back. So this was an FT article. This shows you how like the mainstream media, I think, is kind of way out of touch with what's really happening. It says OPEC oil price war will halt shale boom, say U.S. producers. It says U.S. shale producers are idling drilling rigs and holding back spending as they shelter from an OPEC-induced price slump that is likely to send American output sharply lower. Number of crews fracking shale oil and gas wells, a crucial barometer of the industry's activity levels, hit a 4-year low last week, and producers have wiped out $1.8 billion from capital spending plans over 2 quarters. Quote, what the administration doesn't quite understand is that we've gone from drill baby drill to wait baby wait, says Kirk Edwards, chief executive, Latigo Petroleum in Odessa, Texas. Quote, we are not going to be putting any more rigs out until prices get back and stabilize in the $75 range. You will see U.S. production start to drop in the fall and into 2026, unquote. I don't think this is because of an OPEC price war. You know, some analysts have said, Anas Al-Haji has said that just because OPEC is restoring these quotas numbers, that doesn't mean the production's actually going to go up or that the countries actually have the ability to increase production. So, you know, I don't think OPEC wants oil to drop to 50. They don't need to do that. That doesn't help them. They've always said that they want a stabilized oil price. And most of the time that kind of means around 80, 85. And that is kind of eight between, 75 and 85, I think is a sweet spot for OPEC because that creates enough cash flow for them to do what they need to do inside their countries, but it also uh, doesn't create a lot of energy cost problems for their consumers. And so nobody's benefits from $50 oil. Well, consumers do, but as far as producers, whether they're in Permian or OPEC, and nobody benefits for having oil, at 120 or 140. Again, I think that oil will eventually, because of the lack of investment, these prices are going to start allowing production get, supply to slow down, but demand is relentless, as we've talked about before. So I wouldn't classify it as an OPEC oil price war. Uh, I think there's a lot of pessimism in the market. I'm not exactly sure oil as plentiful as everybody says, but we'll have to wait and see. Price is what it is. Price is the determining factor. It doesn't matter what different analysts think, what I think. Price is the determining factor. And you're hearing it right here from somebody in the Permian in Odessa. We're not going to be putting any rigs out until prices get back and stabilize in the $75 range. That doesn't mean to just hit it and you start going, then stabilize in that range. So we'll see. You will see U.S. production start to drop in the fall and into 2026. So there you go. I thought this was interesting. Sell overvalued, buy undervalued. Oil at 30-year low relative to the S&P. Well, we have to not include the drop in based on the pandemic, but looking at this relatively wise, the S&P in my mind is very overvalued and oil is very undervalued. And do I want to, this doesn't necessarily mean anything. These relationships are just relative. I think for illustrative purposes of showing how one asset class is very overvalued and one asset class is very undervalued. And I would suggest to you that this is likely going to change over time, where the S&P is going to become less overvalued and oil is going to become less undervalued. So I wanted to point this out. This is the GDX fund flows chart. This is interesting. GDX being the basically senior gold miner ETF. A lot of talk you see going back for a while here. These are the weekly flows. This is 6-month net flows were an outflow of $2.54 billion. But over the last several weeks, we've seen basically a turnaround and flows starting to go up into gold funds. So again, this is another indication to me that gold is nowhere near, or at least gold miners are nowhere near their top. Will there be pullbacks? Yes. Will they be violent and volatile? Yes. Is that a buying opportunity? Yes. We're in a bull market. I think again, I'll state this for the record again, that I feel like the underlying factors that are helping to make the gold price go higher, which is basically all Western governments, basically all governments uh, abusing their ability to, with their paper currencies, by creating a lot of currency units is going to continue. Many reasons that we've talked about before. And because of the basically declining U.S. hegemon as it thrashes around, people are less interested in holding the U.S. dollar or holding U.S. Treasury securities. And so I think, gold is going to reemerge as money. It's always been money, but the recognition of it as money is going to cause, I think, more and more people, more and more banks, central banks, more and more governments to look at it that way and accumulate it. And that's what we've seen. Retail hasn't caught on yet because retail's enamored with the AI revolution and stonk always go up, which is the current theme. And so eventually, I believe that will change, and we will eventually have a mania in gold stocks, and you'll see kind of what you see on the bottom here with all the red. That will all kind of how it will be in green, and that will be our indication when everybody, is flowing into these gold mining stocks. Um, that will be our indication to leave the party, but we're not there yet. We're, people will say, well, gold's overbought or it's played out. I mean, yeah, if your circle of discussion is gold bugs on FinTwit, you might get that impression, but the overall, the average person is not even thinking about gold mining stocks. That will change, I believe, over time. So I guess U.S. uranium production has a heartbeat. Here is the EIA that came out last week with the 2024 production, which was about 400,000 pounds. Again, if you have higher prices, cure the problem. We have more and more companies trying to mine uranium here in the U.S. We've got to look at this. This is ridiculous. I think all of our reactors together use around 40 million pounds a year, and we produce 1% domestically of what we use. That's crazy. I think uranium's going higher. Again, how do you represent that in a legitimate investment position? That's where the real trick is. As we've seen, many of these mining companies have been trying to bring some of these older mines that were mothballed back in production, and just about every one of them has had a problem. And so we'll have to see if they can get this squared away or if higher prices end up just curing the problem. I believe that at some point we're going to have much higher uranium prices. They're needed to stimulate production and to even make these marginal producers, no matter how bad the management is or the property is, make it so that they can profitably mine uranium. That's my view. So I thought this was interesting. It was an article that was in Fortune magazine, but it was on Yahoo. It says AI experts return from China stunned. The U.S. grid is so weak, the race may already be over. It says in the U.S., surging AI demand is colliding with a fragile power grid, the kind of extreme bottleneck that Goldman Sachs warns could severely choke the industry growth. In China, this person they interviewed, uh, skipped around a little bit, was is supposedly a Chinese AI expert. They went to China and were checking things out. This power problem, it's considered a quote solved problem. Ma, a renowned expert in Chinese technology and founder of the media company TechBuzz China, took her team on the road to get a firsthand look at the country's AI advancements. She told Fortune that while she isn't an energy expert, she attended enough meetings and talked to enough insiders to come away with the conclusion that send chills down the spine of Silicon Valley. In China, building enough power for data centers is no longer up for debate. Quote, this is a stark contrast to the US, where AI growth is increasingly tied to debates over data center power consumption and grid limitations, unquote, she wrote on X. So this is another part and parcel of 40 years of neglect by the political class, by the establishment, by the intelligentsia. It wasn't the fact that, well, Noah and John could see this data center thing coming and AI coming. Yeah, but I've talked about this for years about power grid, the infrastructure of the US. We financialized the economy. It was all about, making a quick buck, outsourcing everything, and not investing in infrastructure. Talk about the American Society of Civil Engineers. gives the infrastructure grade every year to the US. And it's not A's and B's, it's D's and F's. Okay. And so now it's starting to hit, and you're starting to see the repercussions of that. As I posted several weeks ago, like up in Pennsylvania, where power prices are up, where in New Jersey, I just saw somebody on Twitter starting to see anecdotal. Hey, my electric bill last couple of years was like 200 a month during the summer. Now it's 350 or 400 because of all of this demand that's coming on quicker than you can increase the supply. So this is where I think a tremendous opportunity exists. Now, a lot of the companies that are publicly traded have already moved quite a bit. So taking advantage of it's going to get a little bit more. You're going to have to distill down further from the more obvious. You can just go out and buy, again, the gas turbine manufacturers, but they've already moved quite a bit, their stock prices. You can go out and buy Quantra and companies like this that build T lines and substations, but again, the stock prices moved quite a bit. And so it's probably worthwhile to distill down into the second and third tier suppliers, innovators, engineering firms, what have you, that are going to be behind this eventual build out that we're going to need. And can we do it in some legitimate time frame? We're living on a grid that's in some cases 40, 50 years plus old. And this, transformers. A lot of you folks don't seem to understand about how precarious the transformer situation is in the world and in the US. I did a study one time. I took on a project when I was with Duke Energy. We had a cogeneration plant that was feeding steam and power to a big refinery down here in Texas. And I was really shocked about transformers on our power block were single points of failure. That means if the transformer failed, you're out of business. It's not like you can just go down to an electrical supply house and buy a main power transformer. Okay. These things are long lead time items, a year plus. Okay. And they're very expensive. And so we started looking at insurance data from our insurance providers. What's the lifespan? And we saw like got the data around the lifespan of transformers, how old most transformers are, what you can do. There's different monitoring devices you can add for different gases inside the transformer that get produced. As the transformer ages, you can determine well in advance if the windings are starting to deteriorate. There's all kinds of these technologies, okay? And we didn't have any of that. And so we started implementing that because you don't run something like that. Have this huge responsibility to supply steam for a refining process, and your main power transformer fails. You don't run it to failure. You should be doing predictive maintenance. You could be analyzing data, and you can use probabilities and say, well, we're starting to see amount of hydrogen being produced inside this transformer is increasing. That's telling us that a certain problem. You put it on an oil sampling regime. You can take oil samples of the oil in there, and you can look at send it to a lab, and the constituencies of that oil that you might be able to see deterioration or problems starting to develop in the transformer, which puts you way ahead. You can say this transformer every year now is having a chance to more and more chance to fail. And so it's time to think about replacing it. And what's that going to cost? And what's the lead time? And what are we going to do if it just decides to fail? So this has not been done in these places. I've worked in many places where they didn't even think about this stuff, or been around people, even in power plants, they never thought about this stuff. And so you have to get there. And I think that's where a tremendous amount of opportunity resides. So I don't know if we'll be able to do it because of our system of governance is kind of skewed not to make major changes. See, in China, they decide they're going to do something, they just do it, and everybody gets on board. It's just that simple. And so that's why they're building, all these double digits in reactors, and we don't have one reactor under construction here in the US. We're flailing about. And so it was the same thing I saw in renewable business. We were adding all these solar farms, which take a year or less to build, and you're adding all these megawatts to the grid, but the grid is not being enhanced to handle all this. So we talked about the PJM up in the Northeast and the prices going up. And that was a tremendous bottleneck for many developers because They didn't have the resources internally to process all of the um, plants coming on and to analyze them and to do the studies they needed to do. And so that created a big backlog. So there's these backlogs everywhere. And then even if you wanted to build all this stuff and do all this, we've talked about this before, where do you get the people? The people don't exist. There's hundreds of thousands of vacancies for these jobs, and because people like me have retired. I'm not going back out on the road and doing this stuff anymore. I don't need to. I made my money. So this is the opportunity. And it's in the trillions of dollars in some cases, at least hundreds of billions, if not trillions. And do we have the wherewithal? Do we have, again, this should be part of a Apollo type thing or national interstate road system like under Eisenhower. These things, along with a big build out of nuclear, would transform this country economically. But that's real leadership. And so we're doing it in fits and starts, I think. We need the president to be out there talking about it all the time. But you get distracted, right? Talking about Ukraine and Israel and all these other things that don't matter to the average person here in the US. They have no bearing on what anything that's happening here. But building 100, 1,000 megawatt nuclear reactors would have a big benefit. Would definitely have a big benefit on this, the mining industry, the electric power and distribution industry. I mean, it's almost infinite, but doesn't seem to we have the leadership. So we'll see what happens. But this I thought was an interesting. Uh, Again, our competitors are not standing by. They're just we need power, we'll build power. They're not afraid to use coal. They're not afraid to build nuclear power plants. They're just moving forward. Okay, guys, that's it for this week. Thank you for stopping by. Thank you for the support. Again, I'm been trying to increase the level of engagement. I'm trying to treat this like a real business now. You're going to see more videos, more information. Again, the reality check is back. I will put a link to it in the show notes. It's over on Rumble. Yeah, I think we're a lot of people so far the feedback's been pretty good. If you're interested in that, you can go check that out on Rumble. That'll be like a weekly thing also. Usually post those on Monday or Tuesday, but we've already put the first one up. So go on over there and check it out if you like it, that kind of stuff, if you were liking my political rants. All right, guys, that's it for this week. We'll talk to you next week. Have a safe one.